Sarah has $1,000 sitting in her checking account. It's not life-changing money. It's not house down payment money. It's just $1,000 she doesn't need this month, and she's trying to figure out where to put it so it actually does something instead of just sitting there losing value to inflation. So she does what every responsible investor does. She Googles best investment June 2025 and gets the same answer she's been getting for 3 years, S&P 500 index fund. Boring, reliable, smart. She's about to click buy when she sees her brother-in-law's text. He just moved his money out of the S&P and into something else. Something that, 6 months ago, would have been called crazy. But in June 2025, it's the thing the smart money is quietly doing while everyone else is still following 2023's playbook. Here's what changed: the risk-free rate, the thing that determines what every other investment has to beat, just did something it hasn't done in 23 years. And if you're still investing like it's 2023, you're leaving money on the table, or worse, taking risk you're not getting paid for. My name is Your Name, I run Money Sketcher, and this is the breakdown of where your next $1,000 should actually go in June 2025, why the math completely changed in the last 4 months, and the one question you need to answer before you invest a single dollar. If you've got money sitting in a savings account or a brokerage wondering what to do with it, hit subscribe, because the playbook just got rewritten and most people haven't noticed yet. Let me show you what broke. For the last 15 years, there was one simple rule: stocks beat everything. Bonds were dead money. Cash was trash. You put your $1,000 in an index fund, you waited, you won. That math worked because the risk-free rate, the rate you get for literally doing nothing with your money, was basically zero. Treasury bills paid 0.5%. High-yield savings accounts paid 1%. You couldn't make money without taking risk, so taking risk made sense. But something happened between January and May 2025 that flipped the entire calculation. The Federal Reserve, after 18 months of holding rates steady, made 2 moves nobody expected. First, they raised the short-term rate another 50 basis points in March. Then, in May, they announced they're holding that rate through at least Q1 2026. Here's what that means in English: right now, in June 2025, you can get 5.4% on a 6-month Treasury bill. Risk-free. Guaranteed. No volatility. No market timing. No company going bankrupt. 5.4% risk-free. Let me put that in context. The S&P 500's average annual return is about 10% over the long term. But that's an average that includes years it dropped 20% and years it gained 30%. And you're taking equity risk, company risk, market risk to get that. Now you're getting 5.4% for doing absolutely nothing. That changes everything. Because now, for your next $1,000, the question isn't should I invest it? The question is, what am I getting paid to take risk? And in June 2025, the answer is a lot less than you think. That's the thesis. Now, quick disclaimers because I can already hear the comments. I'm not a financial advisor. This is not financial advice. I'm not telling you where to put your money. I'm showing you what changed in the math and giving you the framework to make your own decision based on your situation. Also, smartest place doesn't mean highest return. It means highest expected return for the actual risk you're taking in the current environment. Sometimes the smartest play is the boring one. Keep that in mind. Let's talk about what everyone's still doing because they haven't updated their thinking. The default answer for where should I put $1,000 has been the same for a decade. Option 1, S&P 500 Index Fund. Low fees. Diversified. Historically 10% annual returns. Set it and forget it. That was great advice when Treasury bills paid 0.5%. Because the extra 9.5% you got from stocks was compensation for the volatility and the risk. But here's the math now: the S&P 500, as of June 2025, is trading at 22 times earnings. That's expensive. Not bubble expensive, but expensive. And when stocks are expensive, future returns tend to be lower. Several major investment banks, including Goldman and JP Morgan, have published forecasts showing expected S&P 500 returns of 6 to 7% annually over the next 5 years. So let's do the math. You take equity risk for 6 to 7% expected return, you get 5.4% risk-free in Treasury bills. You're getting paid 0.6% to 1.6% to take all that risk. That's not a good deal. That's barely a deal at all. Option 2, high-yield savings account. The second default answer. Put it in a high-yield savings account at 4.5%. Better than a checking account. Worse than Treasury bills. And here's the thing nobody tells you, that 4.5% is variable. The bank can change it whenever they want. Most of them have already started lowering rates quietly. Treasury bills are locked. High-yield savings rates are not. That difference matters. Option 3, pay down debt. This one's actually still good math if you have high-interest debt. If you're carrying a credit card balance at 22%, paying that off is a guaranteed 22% return. But if your only debt is a 3.5% mortgage or a 4% car loan, paying that off early when you can get 5.4% risk-free doesn't make sense. You're giving up free money. So the old playbook is either offering you barely any premium for risk or offering you less than the risk-free rate. What's the new playbook? Here's where your $1,000 should actually be going in June 2025, depending on your situation. This is the boring answer that became the smart answer. 6-month Treasury bills are currently yielding 5.4%. You buy them through treasurydirect.gov. No fees. No broker. The US government sends you a check in 6 months with your interest. Here's why this became the default: it's not just safe. It's the baseline. It's the return you get for taking zero risk. Which means everything else you do with your money has to beat 5.4% or you're making a mistake. You're not investing in Treasury bills. You're setting the bar every other investment has to clear. And here's the kicker: they're state tax exempt. If you live in California or New York with high state taxes, that 5.4% is actually worth 6% plus after-tax equivalent. For most people, for most of their next $1,000, this is the answer. Not because it's exciting. Because the math says you're not getting paid enough to do anything else. If you're willing to take a tiny bit of credit risk, very high-quality corporate bonds are yielding 6.2% to 6.8% right now. These are bonds from companies like Microsoft, Johnson & Johnson, Coca-Cola. Companies that aren't going bankrupt. You're getting an extra 0.8% to 1.4% for taking minimal credit risk. You can buy them through a bond ETF like LQD or VCIT. Low fees, diversified across hundreds of companies. Here's the risk: if interest rates go up more, bond prices go down. But if you hold to maturity, you get your principal back plus the interest. This is for the person who says, I understand Treasury bills are the safe play, but I'm okay taking a small amount of risk for a small amount of extra return. That's fine. Just know what you're doing. You're getting paid 1% to take credit risk and duration risk. Make sure that 1% is worth it to you. If you're willing to take real equity risk, and I mean real risk, not just stocks always go up, wishful thinking, there's one area that actually has a margin of safety right now. Deep value stocks in the energy and utility sectors are trading at 8 to 10 times earnings and yielding 4% to 5% in dividends. Companies like Chevron, ExxonMobil, Duke Energy, Southern Company. Boring, hated, and cheap. Here's the math: you get a 4.5% dividend, which is almost as much as the risk-free rate. And you're buying the stock at a valuation that implies zero growth forever. If these companies just exist and do what they've been doing, you're getting 8% to 10% annual returns, dividend plus modest growth. If energy stays in demand and utilities keep being utilities, you get more. But, and this is a big but, you're taking equity risk. These stocks can drop 15% in a month if oil prices fall or the market has a tantrum. So this is only for money you can afford to lock up for 3+ years and stomach the volatility. Here's the decision tree. Can't afford any risk? Treasury bills. 5.4%, sleep at night. Want a tiny bit more and can handle small volatility? Investment-grade corporate bonds. 6.2% to 6.8%. Willing to take real risk for real potential upside? Value stocks in energy utilities. 8% to 10% expected with volatility. That's the new playbook. Here's what I need you to understand: this isn't just interest rates went up. The entire opportunity cost framework changed. In 2023, the risk-free rate was high, but everyone expected it to come back down quickly. So the play was lock in long-term bonds or buy stocks cheap before rates drop. That's not where we are in June 2025. The Fed has made it clear rates are staying here. Inflation is stickier than they thought. They are not cutting aggressively. The 5% plus risk-free rate isn't a temporary spike. It's the new normal for at least the next 12 to 18 months. That changes the entire calculation. When you could only get 0.5% risk-free, paying 22 times earnings for stocks made sense. You had no other option. When you can get 5.4% risk-free, paying 22 times earnings for stocks is expensive. You have a very real alternative. And here's the behavioral part that matters: in June 2025, taking zero risk isn't sitting on the sidelines. It's an active decision that pays you 5.4%. Cash isn't trash anymore. Cash is a competitive asset class. That's the mental shift most people haven't made yet. They're still operating like it's 2019, where you had to take risk to make any money. You don't. Not right now. And that means the risk you do take better be worth it. Okay, let's talk to Sarah. Let's talk to everyone sitting on $1,000 trying to figure out what to do. Here's the only question that matters. What am I getting paid to take risk? Not what's the highest return. Not what's everyone else doing. Not what did well last year. What am I getting paid, in excess of the 5.4% risk-free rate, to take the risk I'm about to take? If you're buying the S&P 500 at 22 times earnings with an expected return of 6.5%, you're getting paid 1.1% over the risk-free rate to take equity risk, market risk, and volatility. Is 1.1% worth it to you? Maybe. Maybe not. If you're buying a value stock yielding 4.5% with 8% expected return, you're getting paid 2.6% over the risk-free rate to take company-specific risk. Is 2.6% worth it? Depends on your risk tolerance. But if you can't answer that question, if you don't know what you're getting paid for the risk you're taking, you're not investing. You're guessing. And in June 2025, with a 5.4% risk-free alternative sitting right there, guessing is expensive. Here's the permission I want to give you: it's okay to take the boring option. It's okay to put your $1,000 in Treasury bills, earn 5.4%, and call it a day. You're not missing out. You're not sitting on the sidelines. You're making a rational choice in an environment where safety actually pays. The market doesn't give you a medal for taking unnecessary risk. It just takes your money when you're wrong. You want to know what I'm actually doing with my money? I'll tell you. Every dollar I don't need in the next 6 months is going into 6-month Treasury bills. 5.4%, risk-free, sleep at night. Every dollar I don't need for 2 to 3 years, I'm splitting 60/40ths between Treasury bills and value stocks in energy. I'm not buying the S&P 500. I'm not buying growth stocks. I'm not buying crypto. I'm not buying anything that requires me to believe in a story when I can get 5.4% for believing in nothing. That might change in 6 months. If the S&P drops 15% and valuations get reasonable, I'll reconsider. If Treasury bill rates drop back to 3%, I'll reconsider. But today, in June 2025, the math says, take the risk-free money, and only take risk when you're getting paid enough to make it worth it. That's not exciting. It's not sexy. But it's what the actual math says to do. Here's how to think about your next $1,000. Step 1. Start with the risk-free rate. Right now that's 5.4% in 6-month Treasury bills. That's your baseline. Everything else has to beat that. Step 2. Calculate the risk premium. For every investment, ask, how much more than 5.4% am I getting, and is that premium enough for the risk I'm taking? Step 3. Be honest about your time horizon. Money you need in 6 months? Treasury bills. Money you don't need for 5 years? You can take more risk. Match your money to your timeline. Step 4. Diversify across the spectrum. You don't have to pick just one. $400 in Treasury bills, $300 in corporate bonds, $300 in value stocks. Build a ladder that matches your risk tolerance. Step 5. Revisit every 6 months. The environment changes. When Treasury bills were paying 0.5%, this conversation was different. When they go back to 3%, it'll be different again. Update your playbook when the facts change. That's the framework. And here's the thing, this isn't just about $1,000. It's about how you think about every dollar. The math changed. The playbook changed. Your strategy should change too. Look, I can't tell you where to put your money. Your risk tolerance, your timeline, your goals, they're all different from mine. But I can tell you this, if you're still investing like it's 2023, you're making decisions based on old math. The risk-free rate is 5.4%. That's not a footnote. That's the most important number in finance right now. And if you're taking risk without knowing what you're getting paid for it, you're flying blind. So here's what I want you to do, before you invest your next $1,000, answer the question, what am I getting paid to take this risk? If the answer is clear and compelling, great. Do it. If the answer is I don't know or not much, maybe the boring play is the smart play. If this helped you think more clearly about where your money should go, do me a favor and subscribe to Money Sketcher. I break down the math most people skip so you can make smarter decisions with your money. And if you want the full breakdown, current rates on Treasury bills, corporate bonds, and the specific value stocks I'm watching, I'll link a free resource in the description. No upsell. No paywall. Just the data. Because the way I see it, the market's already tilted enough toward the people with Bloomberg terminals and analyst calls. The least I can do is make the public data a little more public. I'll see you in the next breakdown. And Sarah? She bought the Treasury bills. 5.4%, 6 months, done. Sometimes the smartest move is the one that lets you sleep at night while still making money.